Over the past 12 months, we've seen a rapid rise in interest rates, a spike in inflation, an inverted yield curve, and an oil price shock. Some people tell you it means this, some people tell you it means that, but I think it means one very clear thing. Jesse Myers put out a recent article titled Strange Tides in Global Macro, where he says everything is weird out there because the Fed's rate hikes have done their damage and the wreckage is now slowly unfolding. For the last few months, things have felt a little weird out there. Is there a recession coming? Are we in a recession already, but it's just not clear? What is the Fed going to do? And then I'm going to jump here to this Kobayashi letter. That's a tweet from @Kobayashi letter. Current situation. 1. Stocks are falling like a recession is coming. But 2. Oil prices are rising like there's no recession in sight. But 3. Interest rates are rising like we have 10% inflation. But 4. Gold is falling like inflation is gone. But 5. Housing prices are rising like rates are falling. But 6. Commercial real estate is falling like it's 2008. Nothing adds up here. And then down here, Jesse says, that's the key piece. The weirdness out there is because the Fed has hiked rates from around 0% to around 5.5% in record time. That takes the oxygen out of the room. It just takes some time for the inevitable to unfold. I really like that word picture right there. Imagine it. You're at a party, and for whatever reason, this party is happening in an airtight room. And all of a sudden, all of the oxygen is gone. Now, some people are dancing. They're going to run out of oxygen sooner than others. Some people are just sitting over on the couch, hoping somebody comes over and talks to them, doing nothing. And they're going to last a little bit longer because they're not using too much oxygen. As soon as they notice that, they might go... So those people, they're going to hang on to their oxygen quite a bit longer than the people that are, woo, yeah. And then you've got some people that are chatting. They're somewhere in between. And they're going to be running out of oxygen sooner than the dude sitting on the chows being chilling, but not as quick as the people dancing and partying it up. So that's the economic situation. When the Fed jacked those rates all the way from around 0% to 5.5%, it is going to have an impact on the economy. There's no way for it not to. It's guaranteed to do something. And those somethings that are coming are going to come in different times, and they will affect different things in different ways, and different industries will be impacted at different points, which will then have a ripple down effect. So even though this person over here is still partying, and it's like, well, everything's fine. Not quite. Deutsche Bank has studied 34 past U.S. recessions to identify key warning signs and found that all 4 are flashing red right now. Predicting recessions is hard. There are simply too many incalculable, volatile variables, as we've seen with the war in Ukraine and COVID-19, that can throw a wrench in even the most well-respected of economists' forecasts. And as Albert Edwards, a strategist at the French investment bank, oh boy, here we go, Société Générale, explained in a recent note, history shows that to the limited extent economists do actually predict a recession, its tardiness usually means they give up waiting just at the point it arrives. The article continues, as the first major investment bank to forecast a U.S. recession back in 2022, experts at the 153-year-old German institution have stuck to their guns this year, warning of another unpleasant, unavoidable American boom and bust cycle. To back up their forecast, a Deutsche Bank team led by Jim Reed, head of global economics and thematic research, earlier this month analyzed 34 U.S. recessions dating back to 1854, looking for patterns in economic history. From the study, the group highlighted 4 key macroeconomic triggers that have caused recessions in the past: rapidly rising short-end interest rates, surging inflation, inversions of the yield curve, and oil price shocks. And ladies and gentlemen, if you've guessed that we've got all 4 of those things on deck, you would be absolutely right. Let's get into it right here. A rapid rise in interest rates, 69%. In this case, not so nice. First and foremost, rising interest rates tend to weigh on economic growth by raising the cost of borrowing for businesses and consumers, which often leads to recessions. In the U.S., Since 1854, when short-term interest rates have risen by 2.5 percent points over a 24-month period, and by the way, it's risen a lot more than that in a lot shorter of a time frame, there has been a recession within 3 years around 69% of the time, according to Deutsche Bank's study. Number 2. An inflation spike, 77% of the time. Inflation soared to a 4-decade high above 9% in June of 2022. That's the 9% they tell us about. Number 3, an inverted yield curve, 74%. Typically, the yield on long-term bonds is higher than the yield on short-term bonds because investors are taking on more risk lending their money out for a longer period of time. But sometimes that equation can flip for a variety of reasons. When this happens, and short-term bonds end up yielding more than long-term bonds, it's called a yield curve inversion. On yield curve inversions, the US again has the highest hit ratio at 74.1%, Reed explained. And focusing just on the period since the 1953 recession, that rises to 79.9%. Said succinctly, about 80% of the time that you have a yield curve inversion, the short-term bonds are yielding you more than the long-term bonds, there's a recession coming. And point 4, an oil price shock. 45%, a mild 45%. Brent crude oil prices have soared roughly 33% since June to over $95 per barrel, leading many economists to fear inflation could prove to be more difficult to tame than the Federal Reserve might have imagined. The thing about boom-bust cycles and recessions and this and that is that they come on the heels of interest rates and lending and borrowing, and none of that would happen in a sound money environment. Or it might happen, but to a drastically reduced degree. If you're interested in owning some Bitcoin, if you want to know why it's the best money to ever exist, please reach out to the ladies and gentlemen over at the Bitcoin Way. Schedule a free 30-minute consultation call and get whatever questions you have answered. I think that this entire situation, all the everything that's going on in the economy is leading to a painful situation. I couldn't tell you what that looks like. I couldn't spell it out that this is going to go down and that's going to go up and people are going to... I have no idea what it looks like. But I do think that you will be hearing on more people's lips as you're out and about, it's harder. It is harder to do anything. It's harder to pay rent. It's harder to put a gas of tank in my car. It's harder to do the things that I want to do. And it's harder every day because the money is losing its purchasing power. And everyday people are feeling it. They feel it. They might not be able, and very few can, put into words why this is happening, but they feel it. It's hard to articulate exactly why. You look at your paycheck and it's about the same, and maybe rent isn't gone up all that much, but when you go to the store, it's this insidious monster that goes up a little bit here, and it chews at you a little bit there, and then it's over here and it gets a little bit more, and you don't notice it exactly, but you feel it, because at the end of the month you're going, I have no money left. I've got $13.26, and this has to last me to my next paycheck, and it's been like this, and it's getting worse as time has gone on? How? This tweet here is from the Kobayashi letter. It says, you can't make this up. 1. Median mortgage payment, $2,900. Median rent price, $1,900. It now costs about $1,000 a month more to buy a house than to rent. Meanwhile, the average new car payment is now at $750 a month. The average interest rate on a used car loan hit a record 14%. All while credit card debt hit $1 trillion for the first time ever, with a record interest rate of, are you ready for this? Ladies and gentlemen, are you ready for this? With a record interest rate of 25%. Basic necessities are becoming unaffordable for Americans, which would explain the tent situation in many cities across the US, because it is so expensive to have a place to live. It is so expensive to put food on the table. But why is this happening? Is it happening because the stars got out of whack? Is it happening because things smell bad in certain parts of the world and they smell good over here? No, it has nothing to do with the stars. It has nothing to do with smells. It has everything to do with corrupt individuals controlling our money. You and I having the ability to spend and save in money being stripped away from us over the course of decades. And there's only one way out. returning to a sound money standard. That is the only way. You fix the money, you fix the world. And thankfully, we have the best money to ever exist. We already have Bitcoin. Now that I've maybe cheered you up or let you down, you can check out this video right there where I talk about the 17.7 trillion, that's right, trillion with a T, that is poised to come and snatch your Bitcoin out of your hands, unless you've got strong hands. But 17.7 trillion is a lot of money coming to take it from you.